Okay, so this topic is about investment appraisal. Now, what does it mean, investment appraisal? Sometimes they call it investment appraisal, or sometimes we call it capital budgeting. Capital budgeting, or investment appraisal, or capital budgeting. Now, what does it mean? Capital budgeting or investment appraisal. You know that if you wanna start a business, right? What do you need? You need a capital, right? How can we raise capital? That's what we study in our topic 5, right? We have various sorts of finance, internal, external. In external, we have short-term, long-term, and the other inorganic source of finance, right? Once we have capital, what are we gonna do with this capital? We will invest, right? We will invest. Where are we gonna invest? Of course, we're gonna acquire various kinds of assets. We call assets acquisition, right? We're gonna buy assets. So before we buy assets, it's very important to analyze the project. It's very important to make a budget of your capital, that how we gonna use this capital. Use means invest. How are we gonna invest? Where are we gonna invest? When we gonna invest? And why we gonna invest? How we gonna use this money? Where we gonna use this money? When we gonna invest this money? And what if we choose project A or project B? Why we gonna use this money? In order to answer all these questions, we will study topic 6, which is today's lecture. That's the meaning of investment appraisal. Now, what does it mean, investment appraisal? Investment appraisal means before you investing your money in any project, it's very important to analyze the project. It's very important to make a budget of your capital. All right. So the idea is before we invest, it is important to analyze the project, or it's important to make a budget. Make a budget. What does it mean, make a budget? Make a budget means same thing. We gonna make a plan. We're gonna make a plan that how we gonna invest this money, where we gonna use this money, when we gonna use this money, why we gonna use this money. All these kind of questions could be covered under this kind of making budget. So plan to use this capital. All right. Again, the next question is why? Why it's important to make a plan for the asset, I mean, for the capital. Why it's so important? Can you tell me why it's important to analyze the project, or why it's important to make a plan to use the capital. This is called capital budgeting or capital investment. Why capital budgeting is important. I repeat, capital budgeting means make a budget, make a plan that how we're going to use this capital. But why it is important? Can you give me an answer? What do you think? Why it's important to make a plan or make a budget? Yes, tell me.
So, in my opinion, I think that we need plan to minimize risk and maximum the profits.
Tell me why it is important. You raise your hand. So give me answer why it's important.
So could you listen to me?
Calculate the risk. I did not understand. What do you mean by calculate? No, I can't hear you. I can't listen to you. You said that we need to plan, right, to calculate the risk. We are not estimating the project. We haven't studied about estimating the project. It's later step. But now the question is why it's important to make a plan. You have a $5,000. You have to make a plan how you're gonna spend this $5,000. Why it is important to make a plan to use your $5,000. We need to plan to minimize risk and maximize profit. No, I think you did not understand what I mean here. You said that we need to make a plan to minimize risk and maximize profit. Yes, that's the objective to invest money. Why we invest money? We invest money to make money, right? If you want to invest money, before you invest money, it's very important to analyze. It's very important to be very thoughtful about the project. You have to be very careful about that investment. Why? That's what my question is. That's the meaning of we make a plan. Why we make a plan? We make a plan so we can do things better, right? If we're not gonna make a plan, what will be happen? So that's my question. Why we have to make a plan? If you don't make plan, what will be happen? If you're not gonna make a plan that how you're gonna use the capital, what will be happen in that case? What will be happen in that situation? You have $5,000. You have 3 different options to invest this $5,000. Before you invest $5,000 in these 3 different projects, why it's very important to analyze the project? Because when you're going to analyzing the project, that means you're making a plan for your capital, that how much capital you're going to invest in project A, how much capital you're going to invest in project B, and how much is in project C. Why it is important? That's my question. Anybody else? Give me an answer quickly. What do you think? What is your view on it? In order to decide which plan is better. Why? Why you need to decide which plan is better? Why don't you just simply close your eyes and you invest whatever you like, whichever project you like? Why don't we do that? Just select whatever you like. Let's say project A, okay, project C. I like these two projects. Why don't we do that? Tell me. Why don't we do that? Give me answer. Why don't we do that? Because we use money of shareholders. So what? Not only shareholders' money. If money come from banks too. So what if we use shareholder money? So what is the connections between shareholder money and the plan to use capital? Is any relationship? Yes. Again, you are telling me choose the most profitable project, but why? But why? That's my question. Why we have to do this? Why don't we just close our eyes and invest wherever we like? Why it's important to analyze the project? If we will not analyze the project, what will be happen? Answer is very simple. If you're not gonna analyze the project, what will be happen? If you're not gonna make a plan for money, you have $5,000. If you're not gonna plan that how much money you're gonna spend where, what will be happen? You will lose money, right? You will lose money. And if you lose money, what will be happen? Can you get money again? No. That's why it's very important to make a plan. So question is, why it's important to make a plan? The reason behind it, it's very important to make a plan in relation of capital because capital is rationing. Capital rationing. Capital rationing. Now, what does it mean, capital rationing? Capital rationing means capital is limited. Capital is limited. If our capital is limited, it's very important to make a plan for capital. It's very important to make a plan for capital because capital is limited. If you're not going to make a plan, you lose the money and you're not going to get money again. It's very, very, very hard to raise money from various sources. It's not easy to raise money like this, especially from the external source of finance, because majority of source of finance come from the externals, borrowing from bank, selling stocks, whatever. That's the majorities of finance come from. So it's not easy to raise money. So whenever we have, whatever money we have, no matter it's a small company, medium company, or large company, for every kinds of company, finance are always limited. That's why if your money is limited, you have to make a plan. You have to make that money, you have to use that money wisely, right? You have to be really thoughtful about that money. Which project is better? That's why it's very important to analyze the project because capital is rationing. So if you make a right project, obviously your money, your investment, use of assets gonna be much more profitable for you. All right. So that's the whole idea behind here. All right. So that's why it's very important to analyze the project, because capital is limited. All right. Now, another question is, how can we analyze the project now? It's very important to analyze the project. We already understand the answer, why. Now, the question is how to analyze the project. How can we analyze this project? So why we have to analyze? This is the first question. Now, second question is, how can we analyze? In order to analyze the project, we have various methods. Those methods called capital budgeting method or investment appraisal method. All right. So that's the whole idea behind this topic, investment appraisal method or capital budgeting method. So it's very important to study capital budgeting or investment appraisal method so we can use our money wisely, right? Because money is limited. So did you get the ideas for this topic? Did you understand? What is the reason behind to study this topic? You understand? Yes or no? Say something. Any question before we move on to the methods? Any question or we move on? Okay, so let's move on. So now next involve methods. So we have methods. So we have 5 methods to analyze the project. So remember, these 5 methods has a different conditions to apply. These 5 methods are less likely to compare with each others. So we cannot, so let's say we have method 1. We can't say that method 1 is better than method 2, or some company apply method 1 and some company apply method 2. No, different method has a different conditions. Different methods has a different purpose. Different methods is giving you different outputs that you need to make a plan. All right, so these 5 methods are not comparable with each others. Each method have their own uniqueness, own characteristics. All right, so in these 5 methods, we will focus only on 4 methods. We will not study all 5 methods. So we have first method is accounting rate of return. Second method is payback period. Third method is net present value method. And the fourth method is internal rate of return. And we have 5th method, which is about we call it capital limitations method. If you have a limited capital, how can we apply these methods? In case of, let's say you have $5,000, either invest in project A or invest in project B. How can we make a decision? So that's mainly method 5. So we will not study about that method. We focus only on 4 methods: ARR methods, second method is a payback period, third method NPV, and the fourth method is IRR, which is internal rate of return. All right. So I'm going to write down here these 5 methods. So we have a ARR method. ARR stands for accounting rate of return. Right. That's the first method. And second method is payback period, which is PBP, payback period. That second method we have. Third method is NPV, which means net present value method. All right. And the fourth method is IRR, internal rate of return. So we have 5 different methods. So as I mentioned before, each method has its own criteria, own things to apply. So we will start with the first method, which is ARR method. So this is the first method, second, third, and fourth. Okay. All right. So the first method is accounting rate of return. What this method about? This method help us to understand when we select the project on the behalf of rate of return. Under this method, we will choose the project which has a highest return. So let's say you have a 2 different project. Project A is giving you 10% rate of return. Project B is giving you 15% rate of return. So in this situation, we're gonna choose project B because project B is giving you high rate of return. Okay. So we apply this method, right? So we apply this method to find which project is giving higher rate of return. Which project is giving higher rate of return, right? That is accounting rate of return. So what is the formula to apply this method? So obviously we have a formula to apply this method. So the formula is average rate of return, or you can call it annual rate of return, whatever you want to call. So let's say annual rate of return. Average annual rate of return. Rate of return divided by initial investment. Now, what is the meaning of initial investment. Initial investment means whatever money you're going to invest in a business to start the business. That's called initial investment. Let's say we have $50,000 and we started a business with $50,000. This is called initial investment. Sometimes we call it initial investment. Sometimes we call it capital outflow. Capital outflow. Initial investment or capital outflow. So capital outflow means we're going to use our capital. We're going to flow our capital, which is out from the business. So we call it initial investment. So initial investment is very first time you're gonna use money. So obviously money gonna out. And what is the rate of return? Rate of return means profit. That money you are generating by using this capital. All right. So that's called the rate of return. So how to select the project? So project selection. Project selection. So project selection depends upon your annual rate of return. If any project which has a higher rate of return comparatively with other project, we will select it. If project has a lower rate of return comparatively others, we will reject it. All right. So this is your accounting rate of return. Now let's have a look at the question, and then you will calculate for me the question. So that I'm going to show you the question. So we have a question here. So here. So that is the question. Calculate accounting rate of return. So it says that an investment is expected to earn cash flow 6,000 annually for next 5 years. So this is your, what is 6,000 pounds? 6,000 pound is your rate of return. And the initial cost of investment is 20,000. And the total profit for the project is 30,000. 6,000 multiplied by 5. So now calculate ARR. So quickly tell me how much is ARR? Quickly calculate ARR. Finish. How much? What is 0.3? What do you mean by 0.3? 0.3. Can you explain to me what does it mean 0.3? I know, but what does it mean zero? How do you explain this 0.3? If someone will ask you about this project, and if someone will ask you a question, what is the ARR of this project? You will say that 0.3. What does it mean 0. How can you explain this 0.3 in simple language? How you define this 0.3? Tell me. How do you define this 0.3? Tell me, how do you define the 0.3? This percentage. 20,000, what do you mean by 20,000? No. Answer is 30%, not 0.3. 30%. 30%. Obviously, you have, this is the rate of return. So you have to multiply by 100. I hope you know these basic things that you cover in your maths. 30% is your ARR. So means this project is giving you 30% return. All right. This project is giving you 30% return. That's the meaning of ARR here. I hope you get it. Now let's do it next question. So let me show you the questions through. So here, can you see that? So here is your question. So can you calculate ARR for this question? How many percent? So that's your average, or sorry, annual accounting rate of return. Understand accounting rate of return? Is that okay? Okay, what is 30,000 in 0 year? 30,000 is your initial investment, cash outflow. That is your cash outflow. 0 means now. Now you start your business by investing $30,000. So $30,000 is your right now. So that means $30,000 is your initial investment. Initial means in the beginning. In the beginning, when you start business, how much money you're gonna invest? That's the meaning of this 30,000. That's your cash outflow bracket. Can you see this bracket here? This bracket means cash out, right? All right, so now let's move on to next method, which is payback period. All right. Let's move on to the next. Second method. Second method is a payback period method. Payback period method. What this method about? This method says that right? This method says that how long it will take to recover all the initial outflow. So means whatever money we have invested in our business, how long it will take to recover all money back. For example, I started my business with $50,000, right? So how long it will take me to recover this $50,000 back? How many years it will take my business will take to recover all money back? So I have two projects. Whichever project is giving me the lowest period, I will select this project. Lowest period means less payback period. Less payback period means this project taking very quick to recover all the money back. Right, so we are quickly recovering money from this project, which is good. As fast as you recover money, more risk will be reduced in your project. Everybody want to cover the risk first, and then later on you think about making money. All right, so that's the idea behind this payback period. How long it will take to pay back, right? Recover money back. So formula. Before we look at the formula, in this method, we have to look at two things, which are two cash flows. So cash flows. Obviously, I'm talking about cash inflows. A cash inflow means your return, money you're gonna earn every year, like as average annual return or the profit you wanna make it, right? So we have two different types of cash flows we have in this project, in this method, or we have two different type of cash flows we have that happen when you invest money. In two different ways you earn money. One is even cash flows, and second one is uneven cash flow. Uneven cash flows. Even cash flows and uneven cash flow. Now, what does it mean, even and uneven? Even cash flow means every year you're gonna earn same return. Let's say first year 5,000, second year 5,000, third year 5,000, and fourth year 5,000. This is called even cash flow, right? Means every year or every period we have equal return. Right? Every year we have equal return, and uneven means we have not equal return, unequal return. Unequal return. Unequal return means, let's say first year you earn 5,000, second year 4,000, third year 6,000, fourth year 8,000, right? So your cash inflows are uneven, not same. Right? In that total period, 1 year to 4th year, your cash flows are mixed, and even your cash flows are constant, are consistent, are same. So two different cash flows we have to look, right? So now, if cash flows are different, obviously the methods to calculate payback period gonna be different as well. All right. So now we look at the method or the formula. So as I said, we have two cash flows. So we have two formulas. First formula using even cash flow. When cash flows are even. So when cash flows are even, formula is initial investment divided by annual cash flows, average annual cash flows or annual cash flows, whatever you want to call it. Annual cash flows. Cash flows means annual return, annual profit you're going to earn, cash inflow, right? And the second formula, when cash flows are uneven. So we have specific formula. So formula is year before full recovery plus next year cash flows and unrecoverable amount AMT means amount, unrecoverable amount, in the beginning of the period. In the beginning. So this formula we have. So these two type of formulas, we will have a look with the help of the calculations, with the help of the question. So always remember, if in the question your cash flows are even, then you apply first formula. And if in the question in your total period cash flows are uneven, then we will apply second formula, which is year before full recovery plus unrecoverable amount in the beginning divided by next year cash flow. All right. So now selection, project selection, project selection. So as I said, if any project is taking very less time in comparison with the other project, we select that project. If project is taking longer period, then we will reject this project. All right. So higher the period, high probability of rejection. Lower the period, high probability of selection. Right. So project is the project selection. So we have three things here: cash flows, formula, and the project selection. So now let's have a look at the question. So this is the question that you can see. The example of uneven cash flow. So you don't have to worry whether it's even or uneven. Right? So the question says that total initial investment is $30,000. The predicted annual net cash inflow over the life of investment are 10,000. So first year, 10,000, second year, 12,000, third year, 16,000, and the fourth year is 14,000. So we can write this one like this. So this is 0, which is initial investment, and 1, 2, 3, 4. So 1, 2, 3, 4. That's the 4 years. Now, before we apply the formula, we have to make a cumulative cash outflow. Cumulative means total cash outflow or cash inflow, cash flows year by year, right? So 0 year, cash outflow, 30,000. If you want, you can write here recoverable or unrecoverable. It depends upon you. If you don't like to write cumulative, then you can write recoverable, recover, or unrecover. So you have two options. You can write, if you like, you can write cumulative, right? You can write cumulative net cash flows, so which means cash flows every year, or recover or unrecover, whatever you want to write. So better you write recover, unrecover. It makes much more sense for you. So now, So start with the zero. So obviously your cash outflows are zero. So your unrecoverable amount also 30,000, 0 year right now, because you invested 30,000. So you need to recover 30,000. So minus means unrecover, and something without minus, which is in positive means recover, or how much you earn it. So first year cash inflow 10,000. So you invest 30,000, right? You invest 30,000, and first year you earn 10,000. So how much left? 20. 20 is unrecovered, right? Second year, you earn 12,000. So recover was 20, and you earn 12,000. Unrecovered 8. How much left? 8, right? Third year, you earn 16,000, right? So your unrecovered was 8. You have to recover 8,000, and you earn 16. How much comes in your pocket net? 8. So 16 minus 8 is 8. So you can write like this. 30 minus 10 is 20, right? 20 minus 12 is 8. 8 minus 16 is 8, right? And fourth year, so you earn 8,000 last year. This year you earn 14. So total you earn 22. So you have to make this column. It's very important, because without this column you cannot apply formula, right? Now what is the formula? The formula is year before full recovery. In which year you recover full money. Remember, unrecover and recover. So year before full recovery year is 3. 3 is your third year, is your full recovery. Full recovery is recovery here, right? And year before, so year before full recovery is year 2. So year before full recovery is 2, right? Plus unrecover before or in the beginning. Unrecover formula is unrecover before recovery or in the beginning. So better you write unrecover before full recovery. So how much is full recovery is here? 8,000. And how much is unrecover? Is 8. So 8,000 divided by next cash flow of next year. Cash flow of next year. So cash flow of next year, obviously after unrecover, next year cash flow is 16, right? Which is 16,000, right? If you solve it, you're gonna get 2.5 years. That's your formula for uneven cash flow. Is that okay, or you want me to explain again? Tell me, is that okay? Or do you want me to explain again? No, you don't have to add, because this formula or this method is not about how much money you are earning. This formula is how fast you are recovering. I give you another example. For example, your initial investment. For example, your initial investment is $10,000, right? Initial investment is $10,000, which is 0 year. 1, 2, 3, 4. For example, first year you earn $5,000. Second year you earn $5,000. Third year you earn again $5,000, and fourth year you earn $5,000. Can you tell me how long this project will take to recover money? How many years? In how many years you recover $10,000? That's your even cash flow. Yes, 2 years. So you do not need to add year 3 or year 4. You don't need to worry about year 3 and year 4 when you calculate this formula. Exactly. That's why when you apply the uneven cash flow formula, you don't have to worry. The formula is unrecovered amounts in the beginning and the next year. Next year cash flow by here is a year recover before full recovery. Unrecovered amounts the beginning of the next year. Unrecovered amounts in the beginning for the next year. 8,000. I think it should be unrecovered before full recovery. I think that's the right formula. So please fix that formula in your notebook. So I think that formula makes much more sense. Unrecover before full recovery. Unrecovered amounts before full recovery. All right? Or unrecover before full recovery, or if you follow, like you said, the formula is unrecovered amounts in the beginning or next year. Next year also the same thing. Full recovery next year. Full recovery next year was in the beginning was 8. Full recovery before full recovery, beginning was 8. Before full recovery 8. So instead of using the formula that I mentioned before, so better you use this formula, unrecoverable amounts before full recovery. So unrecoverable amounts is 8,000 and full recovery was this. So before is this. So that's why we are using 8,000 here. Right? So use this formula that I'm writing on this lecture slide. Cash flow of next year. Cash flow of next year means next year of unrecoverable, unrecovery year. So if you write, you can write cash flow of next year of, remember cash flow of next year of unrecoverable amount, unrecovered amount, or next year of this year, next year of this year. This year was 2 and next year was 3. So that's why 16. So it's two different things that you can understand. Cash flow of next year means this, next of this. If it's 2, next will be 3. If this is 3, next will be 4. So you can write down cash flow of next year of year before full recovery, or cash flow of next year of unrecoverable amount period. Unrecoverable amount was 8, which is 2. So next is 3. Any other question? Any other question? Yes or no? If no questions, then can we go for a break now? Say something, if no questions. Okay, so let's have a break and then we will do some more practice. So I will not move on to the next formula, which is net present value. We will do some more practice about this payback period. So I'll give you some question and then you can practice, right? If everything is fine, then we move on to the third formula, all right? So now we can have a break. So I'll see you soon. Thank you. Okay, so let's start with the now class activity in relation of payback period. So we still continue with this topic. So let me write down the formula once again, and then we will continue. So the formula is year before full recovery before full recovery unrecoverable before full recovery and next year cash flows. Next year cash flows. So next year means next year of this. So if this is the second, so then we will check the cash flow of the third year, right? So now let's do some practice question here. So question says that project has the following cash flows, right? First year 25, second 35, third 35, fourth 40, and fifth 50. So obviously this is uneven cash flows. So for this uneven cash flows, can you calculate payback period? So just take 5 or 10 minutes to calculate payback period and give me the answer, right? So now let's have a look at the answer of this question. So this is recoverable and unrecoverable amount, right? So first year is same, which is 105,000, right? Second year, how much we recover? 25. So 105 minus 25 is how much? 80,000. 80,000 left, right? Unrecovered is 80,000. So 80,000 minus 35. So 45,000, right? 45,000. 45 again unrecoverable. And 35, so 10,000 is unrecoverable.
And here is 30,000, right? And 80,000. 3.25. I think so, it's 3.25, but let's check. So the formula is year before full recovery. Full recovery year was 4. So before is 3. So 3 plus what is the formula? Unrecoverable amount. Unrecoverable amount before full. So which is 10,000, right? 10,000 unrecoverable amounts before full recovery. Before full recovery, be unrecoverable amount is 10,000 divided by next year cash flow. Next year of third is a fourth. So fourth year cash flow is 40,000, right? So this is 3.25 years. I don't know why you calculate 3.3. So 3.3 is wrong. 3.33 is wrong. So 3.25 is the answer for your payback period method. Is that okay? Is that fine? Any question regarding this class activity? Any question? Yes or no? Will we move on to next question? Okay, so let's move on to next. Okay, so here is your next class activity. So can you calculate? Okay, so you have to calculate ARR and select the project. Select the machine. Which machine, which project you want to invest in, A or B, right? Calculate both and give me answer. How much is ARR for machine B? B is 43.3. Let's check. The formula is average annual return. So average annual average annual return for machine A. How much is average annual return for machine A? If we calculate A, 15,000. Yes, because 4,000 divided by 4, it's 15. Divided by cash outflow is how much cash outflow? 30,000. So how many percent? 50%. That's for machine A. Machine B, average annual return is 13,000 divided by 30. How much? It's 13 divided by 30. 13 divided by 30. It's 43.3%, right? So we select machine A and we reject machine B. All right. Now, same question, but now calculate payback period and select the project. Do that for payback period method. Which machine we should select? Why do you choose B? How much is payback period for machine B? How did you calculate machine A? How did you calculate for machine A? So let's have a look and then we calculate for machine A. So year before full recovery. So you can see full recovery year, because here is 0, 0, 0, 0. So full recovery is year 4. So year before full recovery is 3, right? Plus, again, this is uneven cash flow. Remember, this is uneven cash flow, and that's even cash flow. So we're going to apply 2 different methods under these 2 different machines. So unrecoverable amounts. So obviously unrecoverable amounts will be 30,000, right? Unrecoverable amount is 30,000 divided by next year cash flow. Next year cash flow is a 4th year, which is 60,000. So this is 3.5 years, right? And for project or machine B, formula is initial investment, which is 30,000 divided by average annual cash flow, which is 13,000. If you solve it, you will get 2.309 or something. So 2.31 years, right? So obviously, project B has a lower period. So we select project B and we reject project A. So see, according to payback period, we select project B. According to accounting rate of return, we select project A. All right, so everybody's okay with this question? Any question, or we move on to the next? Any question, or okay, all right. So let's let me have a okay. Let me check for more practice question. Right? Now have a look at this question. In this question, so you don't worry about this information. So you don't worry about it, right? So don't worry about it, right? So you have 4 projects, 1, 2, 3, 4, and that's your cash flows, right? So now you have to apply ARR and you have to apply payback period. And then you need to tell me which project we should select following ARR and which project we should select following payback period. All right, calculate now. Please tell me, have you done? Yes or no? If not, then we can stop here. So you can consider this one as your class activity, right? And next week, when we start with this topic, then I will check the answer. Is that fine? So that's your homework. That's your homework. Maybe some of you nearly finished, but let's have a look at the homework. All right. So we stop here. Then I'll see you next week, Wednesday, 1 p.m. to 4 p.m. All right. So I will send you invitation maybe tomorrow or maybe on Monday. Right. So please send me email if you have any question. So I'll see you next week. Thank you. Bye-bye.
So